Michael, thank you so much for being here with me today. I don't know if there's anyone else. I guess there is because we just spoke about it. That there's some people out there that actually post more than you on Seeking Alpha. But I think over 2.1 thousand different stock analyses over your time since you've been posting on Seeking Alpha. Unbelievable. I don't think there'll be a stock that I bring up that you don't know at least some sort of deep dive into that you've gone through. So this will be a fun conversation. But I wanted to focus mainly on what you're putting your money into, which happens to be things like Opendoor, like HIMS, like a bunch of other things that we're going to be covering in energy transition. But for now, tell me your sort of thesis on Opendoor, why you think that this stock is, worth a percentage of your portfolio, and then potentially why it's also almost 4x in the last 6 months.
Okay, so I believe that by putting out a lot of ideas out there, you are leaving a track record for yourself to see, this is what I thought, this is where I was right, and this was where I was wrong. So by following a lot of companies, you get a feel, sentiment for like what's really cutting through. And you
Sure.
can check yourself, if you're, it depends on how hardworking you are, but you can be quite brutal with yourself and say, this is what I thought 6 months ago. And I read through my own stuff, and I'm like, okay, that was my perspective then, and I can see how it takes over. So I can see kind of common threads that overlap at certain points in time.
Yeah.
So particularly with Opendoor, I'll be upfront, and when our members, when I pitched Opendoor to my members, it was $8 a share, and it went from $8 to 80 cents. And I normally would have just cut that. I would have cut it like long time ago. But the reason I made one exception and didn't cut this stock is because it's, I think investing is a lot about, like, when you listen to Warren Buffett, he's quite simple, right? For example, the Coca-Cola investment that they did, like, he just says, as long as the number of units of Coke, the volume is going up and the number of shares outstanding are going down, over time, I'm your man. So it's something
Yeah.
simple, right?
Yeah.
Some people like to kind of make really convoluted pitches and like, oh, before about this, like none of that matters, right? It's a very simple thesis. And in investing, because it's more of an art than really a science, but in investing, people have the ability to make something quite complicated when it's really straightforward. And the clearer your thesis, the more you can question to see if it's actually paying out. And I think that the way to think about Opendoor is really like this, right? So there's a lot of jazz around this company, okay?
Oh,
And
just
the
lost you.
jazz plays out two ways. It plays out. Can you hear me? I can hear
I
you.
can hear you now. Go ahead. Go ahead.
Yeah,
Sorry,
okay.
it cut
Sorry.
out for a minute there, or a little bit.
Sorry. Thank you. So basically, with Opendoor, there's a lot of jazz around this company, and when sentiment is hot, like, people love jazz, and when sentiment cools down, people like drop
Yeah.
at
Yeah.
everything, right? And what happens is that with Opendoor had this iBuying idea, and I'm going to just explain that if people do not really know about it. So the idea is that they're buying a property for less than it's worth and selling it a slightly more than it's worth. Okay, the
Right.
margin that they're trying to make is between 4 and 6% over the course of a year. Okay, it's relatively simple. It's like a merchant, right? If you're Costco, you want to buy something, some inventory for less than it's worth, and you want to sell it for a little bit more than it's worth. And then you have a lot of volume. So it's exactly the same. It's not more complicated than that. And when when they started kind of coming out and were getting a lot of revenues through their business, Zillow thought that they would do the same thing. Okay. And Zillow, this is what they do, right? This is their, like, day in, day out. This is like real estate is their domain, right? These guys own the lane, okay? And they thought, okay, these upshots are kind of coming in and they're kind of trying to do something. Let's kind of do the same thing. And they went through it and they found out, actually, even when property prices were kind of coming a little bit higher, even in that period, they were not able to make the model work. They, even when property prices were still coming up in the back end of 2021, they still, in that period, they just couldn't be profitable. And
So why was that specifically that they couldn't make the model work where other players like Opendoor have?
so This was the theory, and I believe this is actually the reality. Okay, so I do own Opendoor, so I am biased, but I hope that I can provide some objective evidence here that allow people to make up their minds one way or another. Okay, so Opendoor had always stated that they had a lot of variables for each one of their areas in the US that they could figure out what is really the pricing mechanism that's changing week by week. They'd always said this, okay? That their data set that starts, I think, in it could have been 2009 or 2008, maybe even 2006. They had enough variables on a weekly basis that they could predict how it unfolds, okay? That had been the narrative. And narratives are interesting things because when the share price is going up, everyone is about the narrative. The narrative takes care of itself. When the share price goes down, nobody cares about the narrative. All that matters is the financials. And you can see this with other stocks like Nvidia, whatever. Like if the narrative is jazzy but the financials line up, it's like it goes to the moon. And conversely, when it's kind of like, people don't really know this, but like in 2008, Nvidia was down 50 or 60% on the back of an earnings report. And it, when things are not aligned, it can go both ways, these narratives. But Opendoor, so they were saying, okay, our model allows us to track how it unfolds the property prices. But what happened, and Opendoor did not expect this, and nobody really expected this, were the interest rates went from approximately zero to the expectation that they would go to about 3 or 4% in 2022. Okay, so this was last year. It went from zero to about 4%. So that's not even a mathematical return. It's like to go from 1 to 4 is like a 4x, but to go from zero, which it was that, to 4% is like, it's not mathematical, right? You can't calculate that. And that caused a lot of fear. And people were like, oh my gosh, what's happening here? So in that fear, you have a business like Opendoor that is highly leveraged. Now, the leverage is tied to the properties. Okay, it's not tied necessarily to the business. The business is actually quite okay. It hasn't got that much. It has a tiny bit there, but it's not really a needle mover. That has a lot of leverage tied to the properties, and the property market just basically collapsed in on them. Okay, so property prices collapsed down. They had a ton of debt, and nobody knows where the floor is going to be. And normally I would have just cut it, but the fact that Zillow had not been able to make it work in the best of times, and there was so much panic in 2022. There's like everyone just panicking. It was like a mist. Like people couldn't really see straight. And I was like, okay, I don't know. This could possibly fail for me, and I don't know how it's going to work out. But my thought process was, let's just calm down. Let's think about Q3 2023. The reason why I thought about that is because the comparables would be from Q3 2022. And I thought myself, okay, by that time, I'll have a lot more visibility because this interest rate hike period that we have been through right now is, it was the fashion to say, but was unprecedented. It was like things happened, interest rates went up, and there was a lot of like confusion, and multiples and stock markets were coming down, and it was like everyone's kind of like, okay, like it was quite confusing. And I just thought, by next year, things will calm down. Normally, I hold things for approximately 12 months, and if it's working, I'll hold it for, let's say, a little bit longer, But if it's not working, I'm not going to hold it forever, Like a lot of people like to kind of buy a stock and just buy and hold forever. And I don't like to do that because buy and hold forever means the thesis didn't work out, right? So I'm just, in my experience, I'm just kind of, I want to buy something and then I don't want to sell it too quickly. I have this kind of 1 year that I buy and I kind of hold it for a year. And in a year's time, you learned a lot about the business. Because the way I think about it is, you don't really know anything about a business until you've owned the stock. You might be the best Apple fanboy. Like you love Apple. But until you've owned a share of Apple, you're like, you haven't got a clue about it. You're like, services, yeah, those services are cool. You're kind of playing around with the apps and stuff like that. But if you own one share of Apple, you'll be like, oh, you know what? Those margins are pretty good. And you're kind of thinking about the growth rates, and you think about the multiples, and you think about valuations. So you're a business owner in that year, and you've learned how to think about not just the share price. The share price kind of, it goes up, it goes down, but you think in the mind the prospects of the business as the owner of the business. There's that quote from Warren Buffett that I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. So those two work together. You have to think about the business, you have to think about the prospects of the business, and having this period where you cannot exit the position for a year gives you a lot of ability to not play into your emotions, because investing is a very emotional sport. Daniel Kahneman has a lot of experiments to show that biases that kind of play in our mind, and
Sure.
people get all kinds of emotions when the share price either goes up too high too fast or the price falls down too quickly. People kind of get a bit dysregulated, and by having this 1 year lockup, it kind of just slows everything down. And
So,
I'll just
okay, go
say
ahead.
a little tiny little thing.
Yeah.
So the way I was thinking about it is, they need to make by 2024, which is next year, they need to make approximately 10 billion of revenues. So if they make 10 billion of revenues, and I took approximately, let's say, the midpoint of what they say is going to be their profit margin. Now, it's a bit skewed here because the profit margin that they're talking about is before stock-based compensation, all those pesky little things. But they say their margin could be between 4 and 6%. Okay, so their idea is that they are competing away with a real estate broker. Okay, so the real estate broker charges a fee for you to sell the house, and you don't know if it's going to sell, it's not going to sell, and there's a bit of inconvenience to it. With Opendoor, you put the property up, you take several shots of your property. 48 hours later, somebody walks in through the door and they double check that things are how you say they're going to be. Obviously, they have their own models to find out in this area the property is really going to go for this price. So the person comes in and they check, and it's a specialist for the area. Often these can be real estate brokers working for a different company. They just kind of get hired as a one-off to kind of go and see the property that it actually is what it is, and they're given an incentive to make sure that it goes through as well at the price that they evaluated it as well. So there's a bit of alignment there of interests, and they say that we're going to make between 4 and 6%. Okay, so they had a batch of properties that they bought in what they call the old Q2 22 group. So this is what they call like the reset part of the business. So Q2 of last year, so a year ago, they had the property prices that they bought, and these were above where property prices went into as the end of the year went. And after the reset, the new batch of properties that they've bought in Q3 and beyond have better operating margins. But this obviously makes sense, right, Tanya? Because if you buy something when it goes down and things then kind of percolate back higher, obviously you're going to make a better margin. And their margins are coming up at 8%. But if you just normalize that and you take a conservative estimate, okay, so they're saying normally they could do between 4 and 6. At the moment, they're running about 7%. But you just say, okay, let's say it makes about 5%. And then you take the debt payments that they've got to make, which you say is about 2% as well. Okay. So you left, let's say, just for round numbers, 2% net margin. So this is a very razor thin net margin business, okay? So if you say they make 10 billion of revenues, they'll probably make around about 200 million of net income. Well, it's not really net income because before taxes, but they've been running at a loss, so they don't really have taxes. So, but let's just say 200 million of net income. So it's priced at approximately right now 10 times net income, which is not expensive. It's not an expensive valuation, provided that things stabilize. And you don't need property prices to come higher. You just need property prices to stabilize, because where they make their money is by buying something for less than it's worth and trying to get a spread. Okay, the spread that they're trying to get is between 4 and 6%. So it was just in that period where property prices were falling, that they were buying properties for more expensive than they could sell them. But typically, over a medium to longish period, property prices tend to go higher. So that's where the business works quite well. But in this event, in 2022, where that didn't take place, they were kind of left stranded with a lot of debt, a lot of properties that they couldn't shake. Now, if you just suspect that things normalize, I think that they will do quite fine. And I'll just finally add one last thing. Sorry, I kind of went on for a tangent here. That they've actually been buying back a substantial amount of their debt in the open market at a 30 and a 35% discount to what it actually trades at. So they are clearly making some money right now. You could say, okay, yeah, look, of course they're making money because this is the seasonal high period for the company. So obviously they'll make some money right now, but they are making money and they are paying back their debt. So yeah.
So I guess like in terms of just the base case for Opendoor, that all makes sense for me. What I sort of worry about, and maybe this is the not just the company side, but the stock side is, you know, do you think management is up to par for this challenge? Do you think stock-based compensation is a massive problem at Opendoor? Because this is just a company that I'm just starting to research. And the actual idea of taking on this large total addressable market is obviously one that's a massive problem, and there is a great margin for them on that spread if they're saving from costs from, you know, real estate agents and everything. But you know, it does sort of worry me that, like, you know, companies like Zillow, for example, if they weren't able to make it, maybe, you know, is it that Opendoor now has to make it, or is it that maybe the iBuying process itself is one that's just, you know, an extremely hard challenge that maybe is not quite cracked yet?
Okay, so the three questions there. Let me answer the Zoom
Yeah.
order. So I can't remember the founder's name. He
Stock-based
was
compensation and
yeah. The
management.
founder's name, I can't remember the guy's name. He was a CEO. He left. Carrie, I can't remember her name. The CFO became the CEO. You know, when it comes to management, a lot of people like to kind of come out with like high quality management and all this kind of stuff, but ultimately it's quite difficult to ascertain the quality of the management team. I'll just give you an example. So if anyone's read Charlie Munger's Almanac, he talks in 2006 about how great Jack Welch was, and oh, if America had more people like Jack Welch, it would be just fantastic America. And as we know, General Electric, it was basically just a ticking time bomb because he was doing all this kind of stuff with the aviation division where they were kind of leveraging and using accounting shenanigans to do this cookie cutting accounting. So even the best of the best minds sometimes get kind of diluted to the share price. That's not really maybe taken a bit out of context, but the point I'm making is even if you're in the business, sometimes it's quite difficult to have a sense of what management is like. So I think that she's quite competent, but let's just put that aside. I think that she's competent, but let's put that aside.
Sure.
When it comes to stock-based compensation, they don't actually make that much. There are some kind of pesky aspects to the business that you kind of have write-offs here and there, which, you know, I'll be upfront about that. But in terms of stock-based compensation, it's not quite a lot. The founder has, I think it's around 1 or 2% of the company. So I think it's like 100 million that he's got. So his incentive is to make sure the share price goes higher. Like, you know, he's not obviously running the company anymore. He's delegated to the CFO, but his alignment is not in terms of getting paid in stock-based compensation. His alignment is making sure that the property, the company does really, really well. Okay. Thirdly, about whether the business prospects are actually up to the task. So there used to be OpenPad, there was Zillow, and I think there was. Say what?
Isn't it OfferPad?
OfferPad, Zillow, and
Yeah.
I think it was Redfin, I think as well. So there were like a few different players that were doing similar variations of this, and they didn't make it work. Now, in the case of Zillow, they had a plan B. Well, they had a plan A. The iBuying was plan B. So they didn't have to go all in. They had a really, really good quality business in advertising. So why bother? Like the two guys there, the founders, they own the company. Like the business can work out. There's no need for them to kind of make things really more complicated than it needs to be. And incidentally, as a segue, I'll just mention that a lot of people talk really highly about something like Amazon, that, oh, look, Amazon made retail and Amazon made AWS and Amazon is going after generative AI. Businesses are supposed to be entrepreneurial. That's the definition of a business. So when Zillow did something and it didn't work out, people are like, oh, I'm dumping the stock and the stock is worthless. And it's like, no, that like definition of a business is you got to basically find out new revenue streams. So that's what Zillow tried. It didn't work out for them, but they went and made an effort for it. Now, I honestly believe that you can see these numbers already for the guidance that Opendoor has provided right now for the new batch of properties that they bought. as I mentioned before, they did buy them a relatively low price. So that's not a fair comparison. But even then, in that case, he said, okay, the margins that we're running on this new cohort of properties is running at about 7.5%. But even in this case, we think over a normalized period, we're going to do between 4 and 6%. So they're telling you straight up, we're going to make about 4 and 6%. And they've said, I don't know how it's going to unfold. I can't see the future. But they said by the middle of next year, they're going to be free cash flow break even. So if you're able to grow and not be burning through a lot of free cash flow, good things can happen. Now, I'll just add one more thing. So when it comes to, like, admittedly, the share price has run up slightly in the last 2-3 months. So I understand that. There has been from Upstart to Affirm to SoFi, whatever the company is, all these multiples have expanded. Like multiples have expanded by about, I think, 30% to 60% in the past 3 months. It's not that fundamentally anything has happened here since the previous earnings season, but multiples have just really expanded. So Opendoor as well, the multiple has expanded. But if you just take a snapshot and say, okay, this business is priced at approximately 10 times earnings, it's not, you're not paying a rich multiple for it, provided that the business can tick along. And most importantly, if the business next year is not burning any more free cash flow, they already have most of their debt is quite laddered up to over the next several years, and it's tied at 4% interest rates. So it's already locked in, and they've already shown an appetite to start paying back some of their debt. So they're trying their hardest to make sure that the business is going to be around for the next couple of years. And right now, I believe, in my opinion, this is a very innovative business, and it's priced, in my calculations, at 10 times next year's earnings. I don't think that's an exaggerated multiple. I think that's a fair multiple. Think of it like this. It's, let's say, a long-dated option in a way, right? You're buying the equity. It could work out quite favorably. It might not work out. There's always a possibility. No business is invincible. But if you buy and you just sit on your hands for about, 12 months, I think that this could work out quite favorably, because you're going to start comparing next year with 2023. And in the first half of this year, the revenue growth rates are substantially negative. So by next year, they've navigated through this property business, through this property cycle. The revenues will look more stable, and all of a sudden everyone's like, oh, you know what, Opendoor is actually not so bad, because there'll be the perception that the business has survived the worst of times. And in investing, one of the most important things is to get into a business when there's going to be an inflection, a change of perspective. That's really where a lot of the upside comes in investing. The upside obviously comes in you holding the stock and you sticking around while the business grows in intrinsic value. But even if you look at some other businesses like AutoZone, which is quite a boring kind of business, the upside comes in that multiple expansion. People think that actually this is a safe investment. I don't know, like if your viewers or whatever own Apple, but Apple's the same. Apple, the revenue growth rates have been decelerating for more than 5-6 years, but it's perceived as a safe haven, right? So you pay a very high multiple for that safe haven. So it's the same here with Opendoor. Obviously, you're not going to get the kind of multiple with Opendoor that you are going to get with Apple. It's always going to be a business that's highly leveraged, highly sensitive to interest rates, but the perception of safety, that's really the thing that investors want to invest in. When the water is safe, people are quite happy to kind of come in and deploy some capital, and it's going to be a better environment because it's going to be a business that's really no longer burning through free cash flow. So if they want to, inevitably they'll have to raise some more debt. It's not going to be a business that's burning down. So you can think relatively the amount of debt that they're going to be able to get in terms of the coupon that they're going to pay is not the same as the coupon that they would pay right now. And that's why right now in the past couple of months, the bonds have started kind of trickling a bit higher, because people are like, actually, you know what, this business is going to survive, and they're probably going to refinance this debt, and it's probably going to come to maturity. So you see it kind of trickling back up. So it's such as all of it is aligned. Like the creditors are aligned, the shareholders are aligned, management is aligned. It seems to be safer business than the share price would lead one to believe.
Right, right. And I do believe that. I do think you really do see it in the stock. Like whenever it 4x's in the last 6 months, it's not because the business 4x. It's because there was a lot of uncertainty, and some of that is kind of washing away. And so people are putting it back to maybe more of an intrinsic value where it probably should have been the whole time. But
So I'll just say one more thing. So just finally, so what they offer you is convenience. Okay, let's say, for example, the reason why Amazon, the retail business, is so successful is no longer because they offer you the cheapest price. That might have been in the start, but now it's really the convenience, right? For some people, even let's say if they're kind of relatively restrained in terms of their monthly income, sometimes you just want the convenience of knowing that you order something, you're going to get it tomorrow morning. There's no questions asked. And the same with Opendoor. If you want to sell your property and you don't want to have it on the market for, like, say, 12 months or, a year and a half, you just want, okay, give me the money. And the more that they have volume coming through, the margins can actually get quite tight for Opendoor. So they're not actually ended up stealing from the homeowner. They actually end up being able to price it quite close to what actually is the going rate. And what happens as a consequence is that word of mouth spreads. So they have an NPS score, a net promoter score of approximately, I think it's a 72 or something like that. So it's like one of the highest net promoter scores. So when it comes to selling the property, people really trust. And that's what ultimately a moat is. A moat is a business you can trust. There's no questions. You go to Amazon or you go to Netflix, you know what you're getting. Like, you know what you're getting. Go to Tesla, and that's why these businesses are highly valued. Like Apple, like there's no questions. You know what you're getting. You might be paying a bit more, but like that's it. There's no question.
So,
and that's the value offers. Yeah.
no, I was just thinking because you brought up stocks that you potentially look at, wanting to invest in based on moats created by NPS scores or inflection points in the business, things that might be turning around. And the first thing that I think about, and you probably know because I think you looked at the channel, is SoFi is a large pick for me. Right? It's a stock that I love. I'm curious to know what your opinions of SoFi are, just based on student loans returning, what you think about the score or what you think about the stock in terms of a potential moat, or if you have any ideas if you've looked into the company recently.
So sadly, if someone kind of Googles me, they'll see that I've been quite bearish on SoFi. This is just my opinion. Other opinions are available.
I knew that before I asked you, by the way.
Okay, thank you so much. Thank you.
Yeah.
Basically, man, it's not going to make it. I believe. I know it's really hyped up, but I mean, I just can't see that it's a compelling enough investment for me. Ultimately, I believe, in my opinion, that this business is run just for the management team, and they're just taking all that stock-based compensation and it's just like ripping it out of the business. And I can't see a legitimate path to profitability. And man, like when they, for example, make these large acquisitions like they made last year, they kind of play around. Which one was it?
Technesis is the company that they acquired last year. They acquired Wyndham Capital very recently.
Yeah, but it was Technesis that I was thinking of. It's like they're not, when you make a large acquisition, you have the ability to make two choices. You can either say, listen, this is how the business is actually unfolding. This is a lot of the inorganic aspects. And you can be quite upfront and talk to people like mature adults and say, listen, this is our margins from Technesis. This is our margin from our own business. This is how it's going to look. So you make a choice. You make an active choice. And you can make an active choice not to do any of that. And it's these little bits that over time make a big difference. Like everyone kind of talks about Warren, and he's playing the long game. Like he's always very upfront. He's not trying to kind of get one over on anyone. Now, obviously, not everyone is like Warren, and but you look at someone like Mark Leonard from Constellation Software. These individuals, they're trying their hardest to make you go on with their journey. So I know it sounds boring to say this kind of thing, but like going back to Graham and Benjamin Graham, and the idea is that you're not trying to run up the share price so that you can then dump it on somebody. If you have aligned yourself with the shareholders of your business, then the stock is less volatile, and if it's less volatile, actually, surprisingly, actually carries a higher premium. Okay,
Right.
and here with SoFi, then like they're not fooling a lot of people. So you look at this business and they're like, you can see that it's really, really kind of volatile because there's no trust. Like there's no trust. And I don't know, the sell side, they have one job. The sell side has one job to write something that's good about your business so that you can then get some kind of business in return, right? That's, like there's very few sell ratings because it just not doesn't make business sense. But in my opinion, you can look through even on Seeking Alpha because it's a very highly followed stock, and there are sell side analysts from big houses putting a sell side on or putting a sell rating on the stock. And for me, the whole idea here is about this debt forgiveness or not, or like that's the thesis that they're trying to SoFi to play out. And I think that
But it didn't go through though.
Yeah, but I think the
Just so we're
market.
aware.
Yeah, but I think the market is trying to kind of see through that already. Like, okay, what is actually your underlying worth of the business? Now, I will, as I said at the start of the conversation, I'm quite happy to be upfront and honest and say about the other side. So this is my view. I'm bearish on this company,
Yeah.
but I'm also quite happy to be impartial and say, okay, this is what they're doing quite well. And in my opinion, the number of customers that they're getting through their app is just like, woo, like through the moon. So anytime, in my opinion, that you have a very high, or let me rephrase, anytime you have a steady and predictable growth in your customer base, you must be doing something right. Okay.
Right.
So it's not the case that, for example, if the business, it's rare, okay, that the business's revenues are going up and the customer base is coming like flattening out. And in fact, I'll give an example. So in SaaS businesses, you have the ability to spike your customer. By that I mean you have, let's say, a net retention rate. Okay, so every year you have a possibility to upsell them something. Okay, and you upsell them something, so you have a high net retention rate. By definition, your revenue growth rates are quite high, but you're not getting a lot of new customers because the new customer coming in is like, I don't want to sign up to a contract where next year I'm going to pay 30% more, right? And you can see this example with, let's say, Snowflake. I know Snowflake is like a business that people just love, stuff like. But you look at this, and I know that they have a really compelling narrative that the CEO is like no holds barred and blah 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 blah. But
Sure.
you just look at this business and you say to yourself, okay, the best example that I can provide to people is if you compare Netflix with Blockbuster. With Blockbuster, you'd go in and you'd hire a video and you'd be quite cost sensitive. Do I really want to hire another video next week? It's like, maybe I feel like it, maybe I don't feel like it. And that pay-per-view aspect to it didn't really work out. Netflix's business is pretty much the same as Blockbuster. You're just paying a monthly fee. There's no questions asked. You watch, you don't watch, you go and see something at the cinema, you're still paying, and they don't care, right? They want to maximize your viewing time, the binging time. They want to maximize how much service they provide to you, like Amazon, right? Amazon has Amazon Prime that you don't pay for, like you pay for the Prime, but you get free videos. So they kind of want you on that platform as much as possible. And in the case of Snowflake, when you're having these high net retention rates, and you look at their customer adoption rate is really, really slowing down. So going back to SoFi, that's the bull case in my opinion. I'm not a SoFi bull because I question whether this business will have clean profitability in the next 2 years, and I don't think it will. Clean, but I don't mean it's like stock-based compensation added back. Like, I mean, let's just be honest, like real clean profitability. I don't think it will have, but I will be the first one to say, okay, a business that has a lot of customer growth, they have to be doing something right because the customer always knows best at the end of the day.
Yeah. So just so we're both aware, like, because there was a lot of things said, and and I'm very bullish on this company. So we both have, our biases on both ends or whatever, and not like you're betting against it, but
Of course,
um,
yeah, I'm not. I have
stock-based
no
comp
position. I have absolutely no position. Yeah.
yeah, stock-based compensation as either a percentage of revenue or in absolute terms in SoFi for the last 3 quarters. Well, in terms of percentage of revenue has been going down for 6 quarters, but in terms of absolute dollar amount has been going down for the last 3 quarters. It's now only about 13% of revenue, which is much more stomachable than the 20
Yeah.
something percent whenever the articles started coming out.
Yeah.
They want to get that below 10% by, I think, in 2024. Anthony Noto, because you were talking about shareholder alignment, the way that I look at it, has been pouring tens of millions of his own money into buying up the shares on just
Yeah.
cash. So
Yeah.
so I find there is some shareholder alignment there. And whenever I read your HIMS article that you sent me, I appreciate that.
Mhm.
I found that I was reading a company that's so similar to the SoFi sort of thesis of
Mhm.
the customer counts has to amount to something. The base of every company is the customer counts, that is that like the trust in the
Mhm.
company and the NPS scores. So if you look at SoFi's lending NPS scores, they're in the 90% ranges. Like
Mhm.
it's unbelievably high. The customer accounts right now have been sort of flat at around 400,000 new members because they're trying to hit that profitability. Now, the right now management is wanting to get profitability in Q4 of 2023. That's the current guidance, but they are actually profitable on on an adjusted basis right now. So aside from stock based compensation and
Mhm.
depreciation amortization, they are actually
Mhm.
bringing in new dollars. Their book value is growing, and some of the parts of the thesis I don't even have to sort of tell you. Like the
Mhm.
total
Mhm.
addressable market of who's going over to fintech is already set in stone.
Mhm.
And then you look at the amount of competitors, or at least this is how I look at it,
Mhm.
of how many of them are nationally chartered banks that can afford to lend out at this rate, that can afford to hold on to the loans for as long as they're holding on to, and accepting these high, rates of returns back. I don't know. I think if you were to honestly, and let's do
Mhm.
another call or something, a
Mhm.
SoFi specific call. I bet
Mhm.
I could change your mind on SoFi.
So I would love to have another call.
Yeah.
And thank you. I appreciate that. So investing is kind of a business where you have, it's a cliche, but you have no cold strikes. You just need to own what you own. Like you need to be like in the zone. Things that don't sit well with you, because like if you look at a lot of businesses, sometimes so it kind of feels a bit funny. If it doesn't sit well with you, that's okay. Move to the next one. There's always another one.
Right.
It
Right.
didn't feel very much for me. I spent a lot of time covering SoFi. I've read through so much of their earnings call,
Hmm.
and for me, it didn't work out. But there are so many other businesses like Upstart and stuff like that I feel like they're even more volatile. Like you look at the whole joke about Upstart, what they even do. We forget like get to Upstart.
Yeah. 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 Yeah.
But it's even more volatile. But when they had the opportunity, when things were hitting the fan, and they had the opportunity to be upfront and honest and clear, I think that Upstart did quite well. And that was a business that I felt okay. I can see that might work better, because with SoFi and Upstart, these are essentially a bet on interest rates. You're really kind of betting that the economy just stabilizes, and you have to kind of you don't want all your eggs in one basket, right? I, for example, own 16 stocks. I don't want all my eggs tied to whether Jay Powell is going to say interest rates are going up or down.
Sure.
And
Sure.
you can see on a day-to-day basis, Upstart, SoFi, Affirm. This is all basically one idea. The correlation is really close. Um,
But don't
and
you find with the other business models with SoFi, like getting into deposits or even the like Galileo and Technisys
mhm,
and doing the processing payments, that they are a little bit more diversified than the extreme volatility of the upstarts or firms that might get, a little bit more concentration in the lending side and interest rate, trying to bet on where that's going to go. I find SoFi a little bit, especially with them having a bank charter, that they do kind of have some flexibility on how to sort of, navigate those waves.
Um, I came a bit. I'll be honest. I came a bit unprepared, but I had some quotes about SoFi, which showed over time how like management had said one thing, and then 6 months later it said like something completely different, and I kind of came a bit unprepared. But yeah,
Yeah, just
maybe
just for everyone, we weren't actually supposed to be talking about SoFi. So
yeah, yeah, yeah.
we were going to talk about Upstart,
Hymns,
Opendoor,
hymns.
Hims.
Yeah,
I don't
yeah.
know. We actually, I think, just passed the 40-minute mark.
That's
If
fine. That's fine.
if
I'm happy to continue. Yeah, I'm very happy. Um,
um, do you want to give me the pitch on Hims? Because I'd
Yeah,
love to
yeah,
learn
sure,
more
sure.
about that
So, like
company.
we discussed already, basically, this is a business. So, Hims is called Hims and Hers. Okay, so
Sure.
there are two sides of the business. Hers doesn't exist yet. There's an idea. It may work, may not. We'll see how it goes. The Hims side, they sell erectile dysfunction drugs and they sell hair loss products. Really, if we just cut it for what it is, they sell these two commoditized products, and typically, if you have, let's say, like a business like this, where they're basically shipping um, to your door something, you're going to be competing on the price.
Right.
And
Right.
for some reason, I can't explain it, but they seem to have a very large Instagram following. And by extent, ironically, even more ironically, because the hers side of the business has actually a bigger, I think it's 2.1 million followers on the her side, even though the business doesn't even exist. But on the him side, it's a bit kind of more subdued. I think it's a million that they got, which I think is really weird. But anyway, they seem to have a business that attracts paying users. So you can pay for a subscription to Hims, and what they claim, and I don't know, but they claim they provide much more than just the drugs to you. They provide to you a dashboard where you can see and track your progress. Now, sounds a bit
Sure.
like Teledoc. It's not quite the same as Teledoc. Teledoc is about if you're feeling unwell, whatever, you need to go and see a doctor, and that's a whole different business. But the idea here is you're selling a product that goes directly to your door. Now, again, it's the convenience aspect of it. Now, typically, I'd be like, okay, this doesn't really work out. But because, after COVID, everyone was at home and everyone was like, okay, everyone's at home taking Viagra, blah, blah, making all those kind of jokes on Twitter and stuff. Next, let's see how 2021 does. 2021 came and they actually continued to grow. And people are
Yep.
like, it's just the kind of work from home bit, it'll fizzle out. And a lot of other stuff like the Teledoc and the Zoom and Peloton, all these came and went, and they actually fizzled out. But Hims, the people paying to subscribe to Hims is still going up, and it's actually
Yeah.
in uh, last quarter Q1 they actually had like the highest absolute number of subscribers coming to that platform. Obviously, you're coming from a big base, okay? So even if you kind of add a bit more, you're going to have the highest absolute. But last quarter, they had 87% increase in subscribers. Now, these are people that are paying. Now, you can make the argument here, which is the bearish argument, that what's happening is that they are using a lot of social media advertising and they're paying a lot in SG&A to get that subscriber on board. And if you're paying a lot, it's a bit like, I don't know if people would know, there was a business called Skills. Skills was also kind of paying a lot for to get a subscriber on board. And then it
My
was kind
audience will know skills.
of, okay. So they were paying a lot to kind of get a subscriber on board. And then those kind of shenanigans, because if you're giving the money out, uh, is that really something that you can say it's just a cost of running the business, or is that
Yeah.
something that you do as a contra revenue? So that means like your revenue is actually not what you say it is, because I'm just giving you money and then you come and spend it on me. Is that like so?
Right.
Wait, anyway,
Right.
let's just
Without
avoid.
without continuous sales and marketing, there really isn't organic growth.
Yeah, correct. So with Hims, the idea here is that the bare thesis had been that they're spending so much on SG&A to get people on board. People would stick around for a short period of time, about 2-3 months, get used to the stuff and then kind of unsubscribe. And that hasn't actually been happening. People are actually sticking around way past a year. And the best evidence that you can see that the business is working is that they're already EBITDA profitable. And now people say, oh, it's only EBITDA, it's only 2%. And that's a valid assertion. It's only 2%. But they're growing north of 50%. So, I mean, when Amazon was growing at 50%, that was a bad excuse. So a lot of people say, oh, this is the next Amazon, this is the next Tesla. Like, okay, let's just put that aside. The fact of the matter is, if your business is growing, let's say, at north of 40%, everything that you make in that business, you should reinvest back into the business. You should get as far away from your competitors as you can, get as much scale as you can, hire the best management teams, get the best infrastructure. In fact, talking of the infrastructure, they are now, I don't know if it's already working this quarter or was last quarter, they are actually hiring out a whole logistics warehouse so that they can deploy the drugs essentially at a higher rate. So if you're growing at, let's say, north of 30-40%, you shouldn't be profitable. You should really just take that money, reinvest it back to the business, and just run with it. And in the case of HIMS, their guidance for next quarter is actually about 50%. So like they're growing so fast. I don't think it makes a lot of sense to really take the foot off the pedal. Now, as it stands right now, this whole idea that they're investing a lot in SG&A and the business is kind of barely profitable, that's been hanging over the stock for some while. And I feel that they kind of have to, make the choice to be a bit more balance profitability. So I feel that they kind of have to inevitably slow down a little bit. But as far as I can tell, the business, it works. It really, really works. And the business has no debt, which I think is quite important as well to think about. Because if you're buying these kind of small cap businesses, it often people believe that just because something is a small cap, by definition, is undervalued. And that's not always the case. Something can be a small cap and actually it's overvalued for what it offers. And conversely, I don't own Microsoft, but you could make the argument that Microsoft, one of the biggest companies in the world, is actually undervalued. So I don't own that stock, but I'm just saying that these kind of ideas that just because HIMS is small, it kind of should be necessarily undervalued. That doesn't play true, but it is actually undervalued. So also, the management's quite aligned. So if memory serves me correct, approximately 30% of the company is held by management's insider. Andrew Dunn, I think, owns about 25% of the stock, and there is a few more insiders that make up the rest. So I think that they own, as an insider of the company, they own about 30%. So what you see as the market cap of the company, 30% of that is held by insiders. And there is a venture capitalist fund that also owns about 4 or 5%, and they have been selling. But that's the venture capital business. The venture capital business, you buy up, you take a position in the company, it makes an IPO, and you dump it. That's the venture capital business. And what happened was, when the share price hit $4, they were actually buying up some portion of the stock in the open market. So these are people that have every incentive to just dump the shares, but they were actually buying more at $4. Now, obviously, share price now is $9, and you can say, oh well, it's already up 100%. But the business, if you just look out, okay, when things come down a little bit, and you just look out to next year, and you just say, okay, yes, it is up a little bit, but the stock by no measure is overvalued. And I'll just say one more thing, that where the share price was yesterday or last month, or how much it's come up from a year ago, that makes no difference. What matters is what the business is going to be worth next year and the year after. What's the intrinsic value of the business? Is that growing or not? And I believe it is. So in terms of the way I think about it is, I like to think of myself as an inflection investor. So I'm looking for people to see a change of narrative. So the narrative that's overhanging the stock is that they have a lot of SG&A, that they're hiring a lot of social media platforms to get people to subscribe to the business. So that's kind of overhanging. But when that's been released and people see, actually, with the passage of time, the business is growing, continues to grow, has some profitability, there's going to be a change in the narrative, and I believe at that point you might see a re-rating higher.
So, yeah, I was looking through this, and I found, because I find myself to be a pretty product focused investor. I find the companies with amazing products do quite well, in my opinion. Probably some of the
Mhm.
ones that have done best for me is like Tesla and Nvidia, just because I personally liked both those products just for myself. And then if the financials match, then I like it. Um, I was looking through their product lines, not only what they offer today, but what they want to get into. And these are massive, massive industries. Like, they want to get into a lot of,
Mhm.
skincare stuff, even pain management, fertility, weight, cardio, testosterone, prostate,
Mhm.
menopause, massive products. Um, and then as I was looking through, just as we were talking, I wanted to make sure that I understood this correctly. So you said something about a fulfillment network. They say their fulfillment capabilities are at 60+%. So is this stuff that they are actually managing themselves, and they want
Mhm.
to grow that in terms of
Yeah,
what they're actually sending out?
yeah, that's correct. Yeah, so they have a warehouse. I don't know if it's already up and running, but it's probably in the works right now. So they bought this warehouse, might have been Q4. So they already have this, their business model. They were using an intermediary for a little
Yeah.
while, but as they scale up, that's what I was saying before, that a business that is growing, you should scale up and you should develop your infrastructure to outdistance yourself from your competitors. And this is one idea that they have. And the other thing that they're trying to do is they hired this the lady, I can't remember, you had it on the screen before. They hired like this kind of a female actress. My wife would know. I don't really know.
Okay.
And you had it on the screen a second, like a little bit ago. Anyway,
Oh,
they're trying to grow their side of the hers business. So at this moment, it's just like a skeleton, but women typically do buy more products than men for like this kind of for healthcare and stuff like that. No, it wasn't that one. This is like, yeah, that lady on the right, like this famous
okay.
actress. Yeah.
Yeah, yeah,
Um, so like for her to kind of speak about stigmas and stuff like that, and apparently, I don't know if it's true or not, this lady had depression, and she'd like to talk about that, about depression, to really get people to open up and uh, look to hers side of the business to try and really to connect to the brand and stuff like that. So there are different
It
things that
it does
may or may
seem
not
like
work.
they're already offering some female products. I don't know if this is under the brand of hers or
Yeah,
whatever, but it does
that
seem
is
like
correct.
birth
But,
control.
but but I don't think that this. I think this side of it is kind of like they're trying. I don't think that it's really working quite well. If I'm
Mm,
honest, this is the aspiration, but this is a business that is 6 years old because they were
yeah,
founded in 2017. So
that's crazy.
like just you can't build Rome in a day. You need a little bit more time, and I think that what they've tried to do is not just to grow at any cost. They've tried to grow prudently. Even the fact that they have no debt is just by definition an example of how they're seeking to grow profitably and seeking to have the right alignment to play the long game. Um,
Do do you have any information potentially? And because I'm a big fan of total addressable markets, how large can the company sort of get into? Of how large this sort of space is,
so,
the personalized medicine space?
so it so it is large, but there's some regulations as well. So it's a bit more convoluted. It they it's quite easy to kind of throw numbers up. Like for example, Nvidia, you'd know this. They said before that the GPU market, when back in 2012 or something like that, they said, oh, the
Mm,
GPU market is going to be like $2 trillion back then, because you just have to come up with a number. And
sure.
like as time has transpired, actually, that version of the GPU market never really got to that aspect. It's this kind of training of AI and inference that really is the next wave. So I'm not a fan of looking at total addressable markets because it's too easy to come up with like these kind of things.
Distort the numbers and
yeah, like I'm trying to remember. Uber had I think it was like 2 trillion as well, like the mobility market that they were saying. Like people
sure.
just kind of throw like any number out there, like me walking to school, like whatever, like no, that's mobility, so I'm not a fan of that. I much more prefer to just take a more bottom up approach and say, okay, this is what the business is doing now. This is what I think it's going to do over the next year to a year and a half, and take it out because that Yogi Berra quote: "The difficult with forecasting is making a prediction about the future." So it's quite difficult to make predictions, particularly about the future. So I don't like to do that. It's
So I just the reason why I also bring that up is because like for the longest quarter, and this is from your article, so I appreciate it. But the year over year growth rates in terms of HIMS was actually growing all through 2022 on a year over year basis, but each quarter. But then as we go on, and like even the guidance for the full year of 2023 and so on, it does seem like it's going to be going like down into the 50 ranges.
Mhm.
And is that because they're putting their foot off the gas pedal for sales and marketing, or is that because how many people need ED pills? you know,
So I think it's a second. I think that is really the second is that it's quite difficult for a business to grow at north of 50% for a prolonged period of time.
right?
Now, I'll just counter that you can go from, let's say, 90 to 50, that can drop, but you can stay at around 30% growth for quite a while. And you can go at 25% for quite a while. You're not paying for any of that right now because it's a relatively cheap valuation that you're paying. So you only need the business to grow at, let's say, close to 30% over the next 5 years, and you've made the money. So it's not that you needed to continue to grow at a bananas multiple. You just needed to kind of tick along at 30% and you'll make more than enough. Because people don't really believe that much that the business can be profitably run, because people believe that you're just hiring people and they churn out. There's so many kind of stuff on Twitter that people say, oh, they're just churning out and no one sticks around after a little while. You kind of get your hair loss products and it either works, the hair loss, or it doesn't, and no one's really subscribing for endlessly for a number of years, because the whole
Sure.
definition of you using hair loss is the product. If you after 3 years you're not getting the hair back, like what's the point? Like you get rid of it. So there's a bear case here, and you don't need the business to grow at 90% for a number of years. You just need the business to really tick along and show that it can be profitable.
Yeah, and it's insanely hard for a company to double every year. So I don't think people expect it. It's just whether the valuation is also pricing
Mhm.
that in. And like I'm just looking at and I could share the screen again, but I'm just looking at their long-term guided they say
Mhm.
long-term adjusted EBITDA margins of 20-30%, which would be a massive increase from where we are today.
Mhm.
Revenues doing 1.2 billion by 2025, 100 million in adjusted EBITDA, which would be far from where we are. But what sort of valuation would that place us at? Do you think that that's a fair value from where we are today?
I think that
Because I don't think this is a cheap stock necessarily.
so I estimate that they're priced up to next year at about 60 times EBITDA, and that is not cheap. That is not cheap.
Mm,
But the way to think about it is, if, for example, a business is growing at, let's say, 30%, people are more than willing to pay a 30 times EBITDA on that. People are more than willing. The market tells you that, right? So
yeah,
if a business gets past a certain amount of scale, operating leverage works in your favor, but they need to show that that is the case. Okay, so this is really the crux of it. Is really, once they get into 2024, can they really start to show that with the scale that they've got, the business actually has some kind of operating leverage? So that's the question mark. You don't need to figure out more than that. You don't need to figure out what's the total addressable market. None of this matters. You just need to know, in the future, next year, can the business be more profitable than it is right now. And that's really what it is. So you don't need to, I believe that uh, a lot of people getting, in my humble opinion, spend too much time getting distracted with valuations. Valuations are interesting, but they're not really the core of it. You need to figure out whether the business is going to be better in 2 years or not. And that's really, when I
Yeah.
talked at the start about Warren's investment in Coca-Cola, is making it really simple. Okay, I just want the volume to go up, number of share prices, just number of shares outstanding to go down. So in the case of him, there's this bad case that they're really spending too much on SG&A, and they need to prove to the market that they get an operating leverage. It's really that simple.
Maybe my last thing, just because I want to kind of understand this, tell me if you know anything about this, is they're talking about some compounding pharmacy in Arizona, where they're making proprietary products there, and potentially Ohio is opening up as well. Is this common? Because I don't follow many healthcare companies, but I do love a hyper growth stock, and that's sort of where HIMS is being placed itself. I know that you've written an article, I think, on Nubank as well, another big stock of mine. Sort of placing in that, like, I'm willing to pay a high valuation for a stock if it has that potential long-term growth rate underneath it. I don't know. Sorry, I'm going to just really say, because I'm also looking at this as well. It's like their multi-month subscribers in the last quarter was the highest that they've ever seen in terms of growth rates. And that if you're talking about a sticky product, this is not people trying the product. This is people that have probably tried the product before and now want a long-term relationship with HIMS. And that's growing faster than even the single month products, which is, really, really compelling. And average revenue per customer is going up. I don't know. It's quite exciting. But tell me what you think of any of the things that I just said there.
So no, so don't get distracted, in my opinion, with that stuff. You need to just
Sure.
figure out whether the business can get operating leverage. Just make it really simple. And you need 2 or 3 more quarters to show that as the revenue goes up, the operating leverage is working in your favor. Everything else is a distraction. Like everything else is like, obviously you need to do your research and build your conviction. That's what I said to you before about SoFi. You need to figure out if this is for you, and you can do your research and stuff like that. But it's really very simple. Can they get past this SG&A issue? It's really the ultimate question, because the way it works via social media is that those websites, they keep charging more and more and more for you to be able to connect up with individuals, and you don't want to be in a spiral where it's kind of running out under you, because Meta and the other ones, that's their business model. Their business model is every year they increase the price that you're paying to reach out to people. So they need to prove that the SG&A doesn't continue to climb in line or faster than their revenue growth rates. You need to show that.
I not to bring it back to it, but I find that very similar to SoFi, where you know they do have a high customer acquisition costs, but then they're getting the highest number of direct deposit users, way higher than what they even guided for. I think they were expecting about 30% of new SoFi Money users were gonna sign up, and it's north of 50. And the direct deposit users are extremely sticky, so they're paying a high customer acquisition cost. The payoff rate is like a little over a year, similar to HIMS, but the customers are sticky as ever. So
I wonder, as I said, I have no position in SoFi, but I wonder whether with the passage of time. So I have this theory that interest rates are going to remain around this level. I don't see that interest rates are going to get cut anytime soon. I have a theory that they're going to kind of stick around this. Even if they get cut, it's going to go to like 4%. It's not going to go back to zero. Forget that. So do SoFi customers after a while say, you know what, I'm depositing my money with you. How about I get a savings rate? Because now it's a bit competitive, like you can go to a different bank, you can just install a different app, and you can, if someone else offers you a higher a savings rate.
But how can they? So SoFi offers 4.3%. Who could possibly offer a higher rate?
So that's the question you need to know. So that's the crux of it, like, because the share price has been stuck at about $6 or $7 for like a year, right? So, or maybe it's 8 now.
I think it's at 8 right now, but
okay, fine. But it's been kind of around this level for like a while now. So this is the argument that one person needs to kind of have some conclusive view on, is whether the customer is actually sticky or not. Um,
Mhm.
because, like I talked about hymns, yeah, I can say many things, and you can present the not about SoFi, just in general. Like, it's quite easy to kind of present a better picture than the reality. And your job is to look at the two sides of the argument. That's why I like to kind of try and like say, okay, this is that way and that way, because your business, you as an investor, you have to have an open mind and not be looking for confirmation evidence. You have to work hard to look for this
Sure.
confirmation evidence. And um, yeah, so
But that's why
yeah,
I'm
it's
happy
not a
to
business.
talk with you. I mean, that's why I don't mind a bear thesis. You don't offend me in any way. I mean, I'm happy to hear you out. But I honestly think as we talk more and more, I might sway you because I find whenever you actually look into fintechs like that, none of very little. You look at like Vero or something like this that actually have nationally chartered bank licenses, which is a massive key for lowering your cost of funding, which will allow you to compete at those high interest rates, offering the 4.3%. And then on top of that, for SoFi, they also have Galileo, which is their processing costs. They issue their own debit cards. Find a lot of banks that issue their own debit cards. You'll find it's
So
very few.
um, oh,
And so I find that they can offer a product that very few can actually
so
compete
do
with.
you know this business Marketa? Do you know this business
Yeah, yeah.
Marketa? So this payment processing side of the business, the margins are awful, and you get a lot of volume, like a lot of volume, like you just like tons of volume, but the margins on it are often not that great. You look at another business called Toast. They're
Yep.
also kind of similar. The
A client of
payment,
Galileo's, by the way.
so it's you get a lot of volume through it, and like your
Mhm.
revenues look cool, but it's quite difficult to make enough margin on it. Um,
So the contribution margin on Galileo right now is a little. I think it's 29% this last quarter. They wanted to keep it at 30. Technisys brought it down a little bit, but together they're bundling those like so. So Technisys is infrastructure technology. They help build the banks, help with the UX UI, and also like the actually storing all the money. And then in terms of Galileo, it's the payment processing, issuing all the different cards, fraud and detection, all that stuff. And together they think that they're guiding for the contribution margin on their tech platform to go from 30 up to 40%. So they're guiding for like that's a 30 something percent increase in what they're guiding for on their contribution margin by putting those two together. And then not only that, because SoFi is now a nationally chartered bank, you can go to a company like Toast, for example, say because they already are a client of Galileo, or Chime. For you, do you know Chime? Chime's a private company. They're Galileo's biggest client. I think they have 15 million customers or something. And you could say because they're just a fintech, you could say, okay, we'll handle all your payment processing. We'll handle all your back end UX UI, and it's all cloud native, all brand new technology that not even the legacy banks are on yet. And then also because SoFi is a nationally chartered bank, you can host your money at our platform. And there's not a single company in the world, Michael, that will do all three of those processes today. None of them do the infrastructure, the payment processing, and the supporting bank license that Galileo has to offer.
Kaspi, Kazakhstan, super app, and like they do this kind of thing.
For other
But
banks?
not for the banks. No, they have their own bank. It's a bit basically like
Sure.
SoFi. But yeah, I like. I'm not as familiar with SoFi as you. It's not a stock that
Oh,
I
I
really own.
one second. I lost your audio there for a sec. Go ahead.
So I'm not. It's not a stock that I own. I don't
Mhm.
really know it as much, and I would have come a bit more prepared. I didn't really think about it.
No.
But yeah, the
It's
next time we have a call, it's game on.
I just better see in the next 10 days or so, or because I know you're pretty quick with it. I want to see another re-look at the thesis. Take another look. And even if you come out and you say it's a strong sell, I'm happy. But you should re-look at SoFi because I think with student loans coming back, with their home loan, they just acquired a company called Wyndham Capital. They kind of got screwed out by their last partner. They were working with a company called Lower.com. Opendoor actually acquired them, and then they stopped working with SoFi. So they kind of lost their home loan business. And then they went with a new company called Wyndham Capital, purchased them. So they're expecting student loans to be coming back, home loans to be coming back. Personal loans are as strong as ever. NPS scores above 90, 90 points. And then you have the direct deposit users growing so much faster. And the financial services, look at the development at financial services for SoFi. It's growing so fast. And then I don't even have to explain the total addressable markets and everything. I mean, just take another look for me, and then we'll have another conversation. But
okay, I sure will. Okay.
Aside from that, I don't know how much time you have left, because I
Yeah,
know that
I gotta get going. I gotta get going.
yeah, okay. We totally missed out on the energy transition stuff
That's fine. That's
that you're
fine.
very strong
I'll
on.
give us something to talk about next time.
Perfect. I'll keep in touch with you, Michael. I really do appreciate the call. Yeah, anything to plug or anything, please tell
Yeah,
us
thank you. So
where people can
basically,
find
yeah,
you.
just look up Michael Wiggins de Oliveira or Deep Value Returns, and yeah, you'll find my platform.
You've got YouTube, Seeking Alpha, Twitter. What do you got?
Yeah, just Google Deep Value Returns. You'll find it.
Perfect.
Thank you.
Thanks, Michael. I'll have all your stuff in the description anyway.
Thank you so much.